Oh shit, we really need to sit down and have a heart-to-heart because honestly, the way people talk about the stock market lately is driving me absolutely insane. I see so many of you guys out there chasing these massive hype cycles, sweating over every single green or red candle on a chart, and feeling like you missed the boat because you didn't buy some random meme coin at 3 in the morning. But let me tell you something that hit me like a ton of bricks back when I was first starting out and looking at my own empty bank account, thinking there had to be a better way than just gambling. I remember sitting in my tiny apartment looking at a screen full of high-growth tech stocks that were all crashing at the same time, feeling that absolute pit in my stomach because I realized I was just hoping for a miracle instead of building a business. And that is when I realized that people are fundamentally dangerously wrong about dividend stocks, and I want to explain exactly why that is before you make the same mistakes I did. If I had to build real generational wealth using just one simple filter, I would not start with the hype. I would not start with what some talking head on the news is screaming about. And I definitely wouldn't start with what is trending on social media. I would start with the companies that have looked the devil in the eye and kept paying their shareholders through recessions, through those nasty inflation spikes, through total market crashes, and through times when interest rates were going through the absolute roof. It is not because dividends are some kind of magical cheat code or a get-rich-quick scheme, but because a consistent dividend tells you something visceral and honest about a business that a fancy PowerPoint deck can never show you. Let me interrupt this whole vibe with a fact that most people in our generation never hear because it doesn't sound disruptive or cool enough for a headline. Did you know that nearly 60 years of hard-cold academic market data shows that high-dividend stocks don't just beat the low-dividend ones? They actually beat the entire damn market over that stretch. I am not talking about some random blog post or a thread on a forum. I am talking about peer-reviewed academic research where they analyzed the top 1,500 US stocks by market cap from 1963 all the way through 2021. They split them right down the middle, the higher dividend group and the lower dividend group, and then they tracked the total compound returns over that massive 58-year period. The result was not subtle at all. It was a total blowout because the high dividend group didn't just do a little bit better. That gap on the chart was so huge, it looked like a mistake. One single dollar invested in that high dividend group grew to roughly 10 times what that same dollar produced in the low dividend group. Think about that for a second. I am talking 10 times the wealth just by picking the boring companies that actually make money and share it with the people who own them. So when some guy in a tailored suit says dividend stocks are boring, my response to them is pretty simple, and I say it with a smile. Boring. Compared to what? Exactly. Boring compared to losing your entire savings on a disruptive company that doesn't even have a path to profitability, because I'll take the boring money every single day of the week, and I'll take it twice on Sundays. Because boring money is a hell of a lot better than losing money with excitement for 500 bucks. Now here's the part that really matters, and you need to lock in for this because the researchers weren't saying that the cash hitting your account is the magic trick. Their conclusion was that the outperformance actually came from the specific DNA of the companies that tend to pay dividends in the first place. We are talking about high quality, profitable, stable, and defensive businesses that have the discipline to manage their cash flow so well that they can afford to pay you. And my response to that is exactly, that is the whole freaking point of why we are doing this. If dividend-paying companies tend to be the kinds of businesses with stronger discipline, stronger cash flow, and stronger durability, why on earth would you ever ignore that as an investor? That is exactly why I put stocks first in my infinity investing framework, because I am not out here chasing a dopamine hit or trying to prove how smart I am with some complex trade. I am building a cash flow machine that works while I sleep, while I am at the gym, and while I am hanging out with my friends. You hear all these monkeys on the internet yammering about the 4% rule, telling you to build a pile of cash and then slowly bleed it dry over 30 years. You might want to ask them why on earth they would buy something with the expectation that they are going to be forced to sell it at some random unknown time in the future just because they need grocery money. In other words, the 4% rule literally forces you to sell your assets, and it might force you to sell at the absolute worst time imaginable. Just ask anyone who tried to retire in 2000 right before the dot-com bubble burst, or in 2008 when the housing market turned into a crater, and ask them how that worked out for them. It sucked. It was terrifying. And it forced people back into the workforce when they should have been enjoying their lives. So after working with tens of thousands of investors and seeing the wreckage of the sell to survive model, I've come to a very firm conclusion. Being forced to sell something you own is the absolute last thing you want to do if you want to be truly free. I want to live off the income my investments produce. I want the dividends. I want the option premiums. I want the ranch royalties. I want the interest. It does not matter to me what the label is, so long as I am not forced to eat the golden goose just to stay alive. I just want the eggs. The golden goose lays, and I want those eggs to be delivered to my door every single month like clockwork. And that is the real fundamental difference between how most people are taught to invest and how I think real investors should actually think. Most people are taught to chase appreciation first. They think it's got to go up 10 times and then they will worry about income way down the road. So they build these portfolios that look incredible on a computer screen when the market is at an all-time high. But when the time comes to actually live on that money and the market takes a 30% haircut, they run into a massive problem. They have to sell it, they have to kill the goose, and they have to do it at a discount. I do not like that model. I do not want to build a pile of assets and then slowly liquidate it until there is nothing left. I want assets that kick off cash right now, and I want that pile of assets to continue to get bigger and stronger every single year. I want to get paid while I still own the asset. I want income without having to dismantle the machine piece by piece. And that is exactly why dividend stocks matter more than almost anything else in your portfolio. Now, let me be crystal clear here because I don't want you going out and making a huge mistake tomorrow. The truth about dividend stocks that nobody tells you is this: the dividend itself is not the magic. The business behind that dividend is what carries the weight. A dividend does not make a bad company good, and a high yield definitely does not make a stock safe. In fact, that is where a lot of people get hurt and end up hating the market forever. They hear me talk about dividend investing and they immediately go to a screener and start looking for the highest yield they can find. They see a company paying 15% or 20% and they think they found a shortcut to wealth. That is not a strategy. That is just yield chasing. And yield chasing is how investors walk straight into a buzzsaw. If you see some random stock paying a giant yield, your first question should never be, how much income can I get? The first question should always be, what is broken with this company that they have to pay this much to attract investors? Because the market usually does not hand out huge yields for free. There is almost always a price to pay. Sometimes the stock price has collapsed because the business is dying. Sometimes the payout is totally unsustainable and they are about to cut it. Sometimes they don't have any free cash flow and they are just paying you back your own money, or worse, borrowing money to pay the dividend. Sometimes the business is weak and the yield is just the bait to lure in retail investors who don't know any better. That is not what I want. And that is not how we play the game inside Infinity Investing. For me, a dividend is just one filter out of 7. It is not the whole story. I want quality. I want durable revenue that shows up every month. I want strong businesses that people still need even when the world is falling apart. I want discipline in the management team. I want a reasonable valuation. So I'm not overpaying for the cash flow. And I want trend confirmation. I want intelligent entry points where the math is on my side from day one. In fact, we use 7 specific criteria on any stock we touch, and the dividend is only one of those pieces. We aren't even looking for the highest yield. We just want to see that it's been at least 2% and that it has been sustainable for 10 years at a minimum. If I am layering options on top of that, which I love to do, I want the option market to make sense and provide that extra layer of safety and income. So I am not just buying dividend stocks, I am buying world-class quality companies that just happen to pay me while I own them. And that is a massive difference in philosophy compared to the guy trying to flip growth stocks in his bedroom. And that is exactly why I start with stocks first, not real estate first, even though I know everyone loves to talk about property. Now, don't get me wrong. I love real estate. It is my second engine, and it is powerful as hell. Real estate gives you leverage, it gives you those sweet tax advantages, it gives you depreciation, and it can create massive cash flow. But real estate is fundamentally more operational. It is way less liquid than a stock, and it takes a lot more involvement. It is more dangerous for a beginner because there is real risk. Just ask anyone who bought a rental property and had to put a $30,000 roof on it 2 months later. That can be a real hammer to your finances if you aren't ready for it. Stocks are cleaner, they are perfectly liquid, they are much easier to diversify, and they are way easier to automate. If you build the right portfolio, they create a growing stream of income without you ever getting a midnight call about a leaking roof or a clogged toilet, and that is why stocks are the first engine. For me, real estate is the second engine, and then after that, I like managed portfolios. I love managed ETFs in areas where I am allocating capital to experienced operators who have better systems than I do. And then I always keep a reserve of about 10% in cash or cash equivalents. And when I say cash, I also mean things like gold, silver, or even Bitcoin. Why do I do that? Because the markets change. Opportunities show up out of nowhere, and volatility creates openings for the people who have dry powder. I always want that flexibility and that ballast to keep me steady when everyone else is panicking, and that is the structure. Stocks first, real estate second, managed strategies after that, and a solid reserve on the side. That is how you build a real financial life, not just a portfolio that you check once a year. It is a system, and the stock portion of that system needs to do one very important thing. It needs to throw off cash. And that is why dividend growth investing fits so perfectly into a modern, fast-paced life. It's not because I am trying to impress people at a party with my paper returns or show off a chart. I think of it like this. If you told me I had a simple portfolio I could buy for a fixed amount, say $1 million, and that portfolio allowed you to retire today and never have to work for a boss ever again, do you really care if that portfolio goes up or down by 40% next month if the income hitting your bank account stays exactly the same? My only care is that it allows you to stay retired and never have to trade your time for money ever again. The fluctuating value of the stocks is just a distraction. It is certainly not the focal point of a free life. When I invest, I want my portfolio to start doing the heavy lifting for me as soon as possible. The best version of this is not just a stock that pays you today, it is a stock that has the power to pay you more tomorrow. And that is the part that people totally miss when they are looking at a dividend yield. When you own a company that consistently increases its dividends, like the dividend aristocrats or the kings, we are talking about companies that have been raising their payouts for 25 or even 50 years straight. You aren't just buying their current income, you are buying a future cash flow stream that keeps going up to protect you from inflation. And that is how a portfolio becomes a real engine. A machine that kicks off cash and grows in power over time. Just look at Warren Buffett. He didn't become the greatest investor in the world by rapidly buying and selling stocks every time the news got scary. He became a legend by holding his investments and having them kick off so much cash that his biggest worry is what to do with all of it. When you layer in reinvestment while you are still in your building phase and you use proper account placement for taxes. Now you have something that is truly unstoppable because the return is not what you make on paper, it is what you actually keep in your pocket. That is why the structure and the system matter so much more than the individual stock picks. The history of the market shows that it delivers returns, but your system determines what you actually keep after taxes and after your own mistakes. And this is also why I never isolate one asset class and pretend it has all the answers to life. Problem, stocks are just the first engine, real estate is the second, and managed strategies are the third. Put those together with your reserves, and now you aren't depending on any one thing to go right. You are building multiple streams of cash flow that can support each other, and that is what real wealth feels like. It feels like a shield, it feels like a fortress, and it gives you a sense of calm that growth investors will never understand. I see so many people skipping the foundation and jumping straight into complexity because it makes them feel sophisticated. They chase appreciation because they think they can outsmart the market, but simple things done well will beat complex things done badly every single time. A portfolio of high-quality businesses that pay you consistently is not flashy. It's not going to make you a viral sensation. But believe me, when I say it works, it provides for your family and it buys you your time back. And if you build that first, that solid income-producing stock portfolio, then everything else you add on top just becomes a bonus. You are building a repeatable system that creates income, protects your capital, and gives you more choices every single year. So when people ask me why I'm so obsessed with dividend stocks, the answer is actually really simple. I like getting paid. I like owning businesses that give me cash. I like building income without having to worry about selling off my assets in a crash. I don't want to be a slave to some weird 4% rule or a fluctuating market price. I like using stocks as my first and cleanest engine in a much bigger wealth plan that covers all my bases. And that is the truth about dividend stocks that the hype chasers will never tell you because it doesn't sell subscriptions to their alerts. They aren't exciting because they are flashy. They are exciting because used correctly, they become the foundation of a life where your money works harder than you do. If you know someone who is still out there chasing moonshots and hoping that one big win is going to save them, please share this with them. Drop a comment below and tell me what sectors or what specific types of companies you think belong in a real cash flow portfolio. I want to hear about your favorite ETFs that produce that consistent cash flow we all need. And if you haven't subscribed to this channel yet, do it right now because I am putting out new videos every week on investing and tax strategy. We talk about asset protection and the legal moves that actually help you keep the wealth you are building before you go. I've got 2 free things for you because I want to see you succeed. First, that free infinity investing book I mentioned. I am going to send you a link to download it for absolutely free. Just type free book in the comments right now and I will get that link over to you so you can read the whole framework. Second, building wealth is only half the battle. You have to know how to protect it. If you want to learn about tax and asset protection, we teach a free class almost every Saturday, and you can join us for the whole day. We have been doing this for nearly 30 years, and I would love to have you as my guest. I will put that link in the show notes for you. It is absolutely free, and it will change the way you look at your money. I am also going to put another video up here that went viral because it covers some of the deeper mechanics of this system. Go ahead and check that out. Stay focused, stay disciplined, and I will see you in the next one. Peace.